Before we begin today's analysis, if you find value in thoughtful, measured financial perspective that prioritizes discipline over hype, consider subscribing to this channel. Subscribe. We approach every topic with the care and rigor that serious financial decisions deserve. No sensationalism, no empty promises, just grounded analysis to help you think more clearly about your financial future. Now, let's begin. Something significant is happening in the silver market right now. And if you're watching the financial landscape with any attention, you've likely noticed the convergence of forces that rarely align with such clarity. We're witnessing a moment where legal developments, industrial demand shifts, and monetary pressures are colliding simultaneously. This is not about chasing excitement. This is about understanding what these signals mean for your financial positioning. The $84 silver price point has entered serious discussion. Court decisions are reshaping market dynamics, and China's demand profile is undergoing a transformation that many investors have not yet fully processed. Today, we're going to examine all of this carefully. We'll look at what's actually happening, why it matters, and most importantly, how thoughtful investors should be thinking about these developments. Whether you currently hold silver or are considering whether this asset class deserves a place in your portfolio, the next 25 minutes will provide you with a framework for clearer thinking. Let's approach this with the discipline that serious financial decisions require. To understand where we are, we must first understand the broader context in which these developments are occurring. The global financial system is navigating a period of genuine uncertainty. This is not alarmism. This is simply an accurate description of current conditions. Central banks around the world are managing debt levels that have reached historic proportions. Interest rate policies are being adjusted in response to inflation pressures that prove more persistent than many initially anticipated. And geopolitical tensions are introducing supply chain considerations that were largely absent from financial planning just a few years ago. Within this environment, precious metals have reasserted their traditional role in portfolio construction, not as speculative vehicles for quick gains, but as strategic assets for those seeking to balance risk across multiple scenarios. Silver, specifically, occupies a unique position. It functions both as a monetary metal with a history spanning thousands of years and as an industrial commodity essential to modern technology. This dual identity creates dynamics that are fundamentally different from gold or other precious metals. The developments we're about to discuss sit at the intersection of this dual identity. And that's precisely what makes this moment worthy of careful attention. Let's address the $84 figure directly. Where does this number come from, and why is it being discussed with increasing frequency? First, a word of caution. I'm not here to tell you that silver will reach $84 or any specific price. Anyone who claims to know with certainty where any asset will trade is either deluded or dishonest. Markets are complex adaptive systems, and precise price predictions are exercises in overconfidence. What I can tell you is why serious analysts are examining this price level and what conditions would need to hold for such valuations to be realized. The $84 figure represents an inflation-adjusted analysis of silver's 1980 peak. In nominal terms, silver reached approximately $50 per ounce in January 1980. When adjusted for subsequent monetary expansion and purchasing power changes, that peak translates to a significantly higher figure in today's dollars. Different analysts arrive at different adjustment figures depending on the methodology used. Some calculations place the inflation-adjusted peak in the $150 to $200 range. The $84 figure represents a more conservative adjustment, essentially asking, what would silver need to reach to match the real purchasing power it represented at its previous major high? This is not a prediction. This is historical contextualization. What makes this analysis relevant today is that several of the conditions that preceded silver's 1980 peak are re-emerging in contemporary form. High inflation environments, monetary policy uncertainty, geopolitical stress, industrial demand pressures. The parallel is not perfect. No historical comparison ever is. But the rhyming patterns are worth understanding. To properly evaluate silver's current position, we need to discuss market cycles more broadly. This is foundational knowledge that will serve you regardless of which asset classes you ultimately choose to focus on. All markets move in cycles. This is not speculation or theory. It is observable pattern across centuries of market data, across different asset classes, and across different economic systems. These cycles are driven by a combination of fundamental factors and psychological dynamics. Fundamentals establish the underlying value proposition. Psychology determines how market participants respond to that proposition over time. In the early stages of a cycle, assets trade below their fundamental value. Sentiment is negative or indifferent. Few market participants are paying attention, and those who are often face ridicule or dismissal. As fundamentals begin to manifest, early recognition occurs. Smart money enters positions. Prices begin to rise, but the broader market remains skeptical. Media coverage is minimal or dismissive. Then comes the recognition phase. the thesis becomes undeniable to a broader audience. Institutional capital begins flowing in. Media coverage increases. Prices rise more rapidly as new participants enter. Finally, in the euphoria phase, mainstream participation reaches its peak. Prices overshoot fundamental value, sometimes dramatically. Everyone is talking about the asset. This is typically when smart money exits and retail participants suffer their largest losses. Where is silver in this cycle? Based on sentiment indicators, positioning data, and media coverage patterns, silver appears to be transitioning from early recognition to broader recognition. This is neither the bottom nor the top. It is an intermediate phase that offers both opportunity and risk. Understanding where you are in this cycle should inform your strategy. Buying at the bottom requires conviction and patience. Buying in the recognition phase requires disciplined position sizing. Buying in euphoria is almost always a mistake. Now let's address the legal developments that are contributing to current market dynamics. This is where many investors lack context, and that knowledge gap creates both risk and opportunity. Recent court decisions have addressed market manipulation claims in the precious metal space. Without commenting on the merits of any specific case, the outcomes have implications that thoughtful investors should understand. When courts rule on manipulation claims, they establish legal precedents that affect future market behavior. They create disclosure requirements. They impose potential penalties that alter institutional risk calculations. And perhaps most importantly, they signal to market participants that certain practices are under scrutiny. The practical effect is often a shift toward more transparent price discovery. When manipulation risks increase for market participants, behavior tends to move toward compliance. This doesn't eliminate all problematic practices, but it does alter the incentive structure. For silver specifically, court attention to the concentrated short positions held by certain institutions has introduced new considerations into trading strategies. Large short positions that might previously have been maintained indefinitely now carry additional legal and reputational risk. This matters because silver has historically featured some of the most concentrated short positions of any commodity market. The mechanics of this are complex, involving futures contracts, delivery mechanisms, and hedging strategies. But the essential point is straightforward. When large, short positions become riskier to maintain, the potential for rapid price adjustments increases. I want to be clear about something. I am not suggesting that manipulation is the primary driver of silver prices. Fundamental supply and demand factors are far more important over meaningful time horizons. But legal developments can accelerate price discovery when fundamental factors are already supportive. Think of it this way. Fundamentals determine the destination, but legal and structural factors influence the speed of the journey. Perhaps the most underappreciated factor in the current silver equation is China's evolving demand profile. This deserves careful examination because its implications extend over years and decades, not months. China's silver consumption has historically been dominated by industrial uses, particularly in electronics manufacturing. This remains true today, but what's changing is the composition and trajectory of that industrial demand. Three sectors deserve particular attention: solar energy, electric vehicles, and advanced electronics. Solar panel production is silver intensive. Each gigawatt of solar capacity requires significant silver content, and China is pursuing solar deployment at a scale that defies easy comprehension. The country's solar installation targets represent a step function increase in industrial silver demand that is already straining existing supply channels. Electric vehicles similarly require meaningful silver content. Battery management systems, electrical contacts, and various electronic components all use silver for its unmatched conductivity and reliability. As China's EV production continues expanding, so does the associated silver demand. Advanced electronics, including 5G infrastructure and AI hardware, represent a third demand pillar. The performance requirements of these technologies often necessitate silver over cheaper alternatives. This is not about aesthetics or tradition. It is about physics. Silver conducts electricity better than any other metal, and for certain applications, that performance advantage is non-negotiable. What makes this demand profile significant is that it is structural rather than cyclical. China is not going to reverse its solar deployment. It is not going to abandon electric vehicles. It is not going to forgo advanced electronics. These are strategic priorities embedded in national industrial policy. The demand pressure is not a temporary spike. It is a sustained pull that will continue drawing silver into industrial consumption for years to come. Now, consider this demand growth against the supply landscape. Silver mining has structural challenges. There are no significant new silver discoveries reaching production. The majority of silver production occurs as a byproduct of other mining operations, meaning supply is relatively inelastic to price increases, and existing deposits are depleting. When growing demand meets constrained supply, prices adjust. This is not a controversial statement. It is basic economics. We've discussed industrial demand, but silver's monetary dimension deserves equal attention. This is where investor psychology and macroeconomic forces intersect. Silver has served as money for longer than any fiat currency currently in existence. This is not a political statement. It is historical fact. Throughout human civilization, silver has functioned as a medium of exchange, a store of value, and a unit of account. The 20th century saw silver largely demonetized in official terms. Government-backed paper currencies replaced precious metals as primary money. But something interesting has happened in recent years. Silver's monetary function is re-emerging in investor consciousness. This re-emergence is driven by macroeconomic conditions that prompt legitimate questions about currency stability. When debt levels reach unprecedented heights, when central banks engage in massive balance sheet expansion, when inflation erodes purchasing power, some portion of investors naturally seek alternatives. Silver offers an alternative that is tangible, divisible, portable, and historically proven. It cannot be printed. It cannot be created by government decree. Its supply is constrained by physical reality. This monetary demand is additive to industrial demand. When both forces are pulling in the same direction, the effect on price discovery is amplified. I want to be careful here. I'm not predicting currency collapse or hyperinflation. These are extreme scenarios that may or may not materialize. But investors need not believe in extreme scenarios to see value in hedging against currency risks. Even modest inflation, persistently compounding, creates substantial wealth erosion over time. Silver serves as one potential hedge against that erosion. Not the only hedge, not necessarily the best hedge for all circumstances, but a historically proven option that thoughtful investors should at least understand. Let's shift our focus to something equally important as market fundamentals: your psychology as an investor. The best analysis in the world is worthless if you cannot implement it with discipline. And discipline requires understanding your own emotional vulnerabilities. Human beings evolved psychological patterns that served survival in dangerous environments. Unfortunately, many of these patterns work against us in financial markets. Consider fear. Fear served our ancestors well when a predator appeared. The fear response triggered immediate action that could mean the difference between life and death. But in markets, fear typically triggers selling at exactly the wrong time. The moments of maximum fear are almost always the moments of maximum opportunity. Consider greed. The desire for more served our ancestors when resources were scarce. Accumulating surplus food, shelter, or tools improved survival odds. But in markets, greed typically triggers buying at exactly the wrong time. The moments of maximum greed are almost always the moments of maximum risk. These emotional patterns explain why individual investors consistently underperform the very assets they invest in. Studies show that stock market investors, on average, earn returns far below what a simple buy and hold strategy would have generated. The difference is emotional decision-making that destroys value over time. Silver is particularly susceptible to emotional volatility. The metal can move dramatically in short periods, triggering both fear and greed in rapid succession. An investor without emotional preparation will be whipsawed by these movements, selling lows and buying highs. The antidote is not emotional suppression. Emotions are part of being human. The antidote is emotional awareness combined with predetermined decision rules. Before you make any investment decision, know your strategy, know your entry criteria, know your position size, know your time horizon, and critically, know what would cause you to exit. When you have these parameters defined in advance, emotional moments become opportunities to execute your plan, rather than opportunities to make impulsive mistakes. If you currently hold silver in any form, this section is specifically for you. Your strategic considerations differ meaningfully from those who are considering entry. First, congratulations on having positioned ahead of broader market recognition. Whether through analysis or instinct, you have an asset that is attracting increasing attention. This is the right side of the trade to be on. But holding is not a passive activity. It requires ongoing management and clear thinking. Your primary risk now is not missing upside. Your primary risk is mismanaging the position as prices move. This typically manifests in two ways: selling too early or holding too long. Selling too early occurs when price corrections trigger emotional responses. Silver can easily decline 10 to 20% in short periods, even within larger uptrends. If these corrections cause you to exit, you will likely lock in disappointing returns and miss subsequent advances. The solution is not ignoring price action. The solution is having a framework for distinguishing normal corrections from genuine trend changes. This requires attention to factors beyond price alone: supply and demand fundamentals, monetary policy developments, and institutional positioning data. Holding too long is the opposite error, and it is equally destructive. Markets eventually overextend. Cycles eventually reach euphoria phases. If you have no plan for taking profits, you risk watching unrealized gains evaporate. The solution is predetermined exit criteria. What conditions would suggest the cycle is peaking? What would widespread euphoria look like? At what point does prudent profit-taking become appropriate regardless of what might happen next? I cannot give you specific answers to these questions. Your financial situation, tax circumstances, and risk tolerance are unique to you. But I can tell you that having answers before you need them is infinitely better than improvising in emotional moments. Consider also the form of your holdings. Physical silver, allocated accounts, exchange-traded products, and mining shares all have different risk profiles and liquidity characteristics. Ensure your holdings match your actual needs and time horizons. Finally, resist the temptation to constantly check prices. The frequency of price checking correlates with emotional decision-making. If you have a sound strategy and appropriate position size, daily price movements are noise. Check weekly or monthly instead. If you're considering silver as a potential addition to your portfolio, your strategic considerations are different from existing holders. This section addresses your specific situation. The first question is not whether to buy. The first question is whether silver fits your overall financial plan. Asset allocation decisions should start from comprehensive financial planning, not from enthusiasm about any particular asset. What is your investment time horizon? Silver should be considered with a multi-year perspective minimum. If you need access to these funds within the next 12 months, precious metals are likely inappropriate, regardless of how attractive the setup appears. What is your risk tolerance? Silver can be substantially more volatile than traditional stock and bond portfolios. Can you emotionally and financially handle a position declining 30 or 40% before ultimately proving correct? If the answer is no, position sizing must reflect that reality. What is your current allocation to alternative assets? Precious metals are one category within the broader alternative space. Overconcentration in any single asset class, no matter how attractive, introduces risks that can overwhelm any upside. Once you've answered these structural questions, the tactical considerations become relevant. Entry timing matters, but not in the way most investors assume. The pursuit of perfect entries destroys more value than it creates. Waiting for pullbacks that never come, hesitating until prices are higher, trying to time exact bottoms. A more effective approach for most investors is systematic entry. Rather than trying to identify the perfect moment, allocate across multiple purchases over weeks or months. This approach ensures you participate in the opportunity while reducing the risk of buying a short-term top. Position sizing is arguably more important than entry timing. A correct position with poor timing will eventually work out. A poor position size will create problems regardless of timing. Start smaller than you think appropriate and add only as your conviction and comfort increase. Form of ownership deserves consideration. Physical silver offers direct ownership without counterparty risk, but requires storage and involves wider spreads. Exchange-traded products offer convenience and tight spreads, but introduce counterparty and structure risks. Mining shares offer leverage to price increases, but add company-specific and operational risks. Most investors are well served by some combination of forms, rather than concentration in any single vehicle. Diversification applies within asset classes, not just across them. Experience teaches that certain mistakes recur with dispiriting regularity among precious metals investors. Learning from others' errors is far less expensive than learning from your own. This is the most common and most destructive error. Buying when prices are soaring because it feels like missing out. Selling when prices are falling because it feels like impending loss. These emotional impulses almost always lead to buying high and selling low. The solution is having a written plan developed when emotions are neutral. Define your strategy in advance and commit to following it regardless of how markets feel in the moment. Leverage amplifies everything, gains and losses alike. Many investors who were right about direction have been destroyed by leverage when short-term moves went against them. Silver's volatility makes leverage particularly dangerous. A leveraged position that cannot survive a normal correction will rarely survive long enough for the broader thesis to play out. If you use leverage at all, use it sparingly and ensure your position can withstand substantial adverse moves without forced liquidation. Conviction is valuable. Concentration is dangerous. Even if you believe strongly in silver's prospects, allocating your entire portfolio to a single asset class introduces catastrophic risk. What if you're wrong? What if timing is worse than expected? What if personal circumstances require liquidity precisely when markets are unfavorable? Diversification is not about doubting your thesis. Diversification is about surviving the scenarios where your thesis proves incorrect or your timing proves unfortunate. Not all silver exposure is equal. Some vehicles introduce counterparty risks that only manifest in stress scenarios, precisely when you most need your assets to perform. Understand what you own. If your silver exposure depends on an institution remaining solvent, a structure remaining intact, or a derivative performing as expected, you have counterparty risk that deserves acknowledgement. Silver can have unique tax treatment depending on your jurisdiction and the form of ownership. Collectibles classifications, short-term versus long-term holding periods, and reporting requirements all affect after-tax returns. Consult with qualified tax professionals before establishing significant positions. Optimization of pre-tax returns that ignores tax consequences is incomplete analysis. The precious metals space attracts more than its share of sensationalism. Price predictions presented as certainties, conspiracy theories presented as analysis, urgency designed to override careful thinking. Consume information skeptically. Ask what evidence supports claims. Consider what incentives inform sources. Hype-driven decisions rarely end well. Real wealth building takes time. Cycles take years to fully play out. Investors who need immediate vindication of their positions will struggle to maintain them through necessary holding periods. If you cannot comfortably wait 3 to 5 years for a thesis to materialize, you are likely underpositioned or overpositioned, but not appropriately positioned. The desire to optimize entry timing leads many investors to perpetual waiting. Meanwhile, prices advance without them, and eventual entries occur higher than systematic buying would have achieved. For most investors, systematic purchasing over time produces better results than timing attempts, except that some purchases will be above average and some below, and focus on the average over the full accumulation period. Every investment eventually requires an exit. Whether through sale, exchange, or bequest, your silver holdings will ultimately be disposed of somehow. Having no plan for exit means leaving that decision to future emotional states. Exactly the condition least likely to produce good outcomes. Define what success looks like. Define what would cause you to reconsider. Define how you would begin taking profits if appreciation substantially exceeds expectations. Some investors become so attached to their precious metals thesis that it becomes part of their identity. They consume only confirming information. They interpret all developments as supportive. They cannot imagine being wrong. This attachment destroys analytical objectivity and prevents appropriate adjustment as circumstances change. Your job as an investor is to be right, not to be consistent. If evidence emerges that contradicts your thesis, updating your views is strength, not weakness. Silver does not exist in isolation. Its performance will be influenced by developments across the broader financial landscape. Understanding these connections improves decision-making. Interest rates matter enormously. Silver and other precious metals tend to perform better when real interest rates, nominal rates minus inflation, are low or negative. In such environments, the opportunity cost of holding non-yielding assets decreases, and inflation hedges become more attractive. Current monetary policy suggests real rates may remain suppressed for extended periods. The debt levels accumulated across developed economies make significantly positive real rates difficult to sustain without triggering fiscal and economic stress. Currency markets matter as well. Silver is typically priced in US dollars, and dollar strength or weakness affects silver's attractiveness to non-dollar buyers. A weakening dollar provides tailwind to silver prices, while a strengthening dollar creates headwind. The dollar's trajectory depends on complex factors, including relative interest rates, trade balances, fiscal policy, and reserve currency dynamics. These factors currently show mixed signals, suggesting currency impacts may be neutral to modestly supportive. Equity markets interact with precious metals in ways that shift over time. In normal conditions, precious metals may move independently of equities. But in crisis conditions, correlations often increase as investors liquidate positions across asset classes to meet margin calls or reduce risk. This means silver is not a perfect hedge against equity downturns. It may initially fall alongside equities before eventually diverging. Expecting silver to immediately benefit from equity weakness sets up potential disappointment. Geopolitical developments introduce uncertainties that are inherently unpredictable. Wars, sanctions, trade disputes, and political instability can all affect precious metals through both fundamental and psychological channels. The current geopolitical environment features elevated tensions across multiple regions. This supports precious metals demand, but also introduces scenarios that could affect supply chains and market functioning in unexpected ways. History does not repeat exactly, but it does provide patterns worth studying. Silver's past can inform expectations about its future, with appropriate humility about the limits of historical analogy. The 1970s bull market in silver saw prices rise from approximately $2 per ounce to $50 per ounce, a 25-fold increase. This move occurred against a backdrop of high inflation, monetary instability, and geopolitical stress. The subsequent decline was equally dramatic. Silver fell from $50 to under $5 over the following years, destroying wealth for those who bought at or near the peak. The early 2000s bull market saw silver rise from under $5 to nearly $50 again, a 10-fold increase. This move occurred against a backdrop of monetary expansion, financial crisis, and growing investment demand. Again, a substantial decline followed. Silver retreated to under $15, representing significant losses for late entrants. What lessons emerge from these episodes? First, silver can generate extraordinary returns under the right conditions. The magnitude of historical moves demonstrates genuine wealth-building potential for those positioned correctly. Second, silver can generate extraordinary losses under the wrong conditions. The severity of historical declines demonstrates genuine wealth destruction potential for those positioned poorly. Third, timing within cycles matters enormously. Early participants in bull markets captured life-changing gains. Late participants in bull markets suffered devastating losses. The same asset produced opposite outcomes based solely on timing. Fourth, cycles take longer than expected. Both historical bull markets spanned roughly a decade from trough to peak. Investors expecting immediate results were frequently shaken out before the major moves occurred. Fifth, euphoria signals danger. The 1980 peak was marked by widespread public participation, media frenzy, and the sense that silver could only go higher. The 2011 peak featured similar characteristics. Recognizing euphoria and responding appropriately is essential to preserving gains. Given the potential for both substantial gains and substantial losses, risk management deserves explicit attention. These principles apply beyond silver to investing generally. This sounds like cliché, but its violation explains the majority of investment disasters. Money needed for rent, food, medical care, or debt obligations should never be placed at risk regardless of how attractive an opportunity appears. Serious investing requires a financial foundation that can withstand portfolio volatility without life disruption. The proper question is not whether to diversify, but how to diversify appropriately. Even within a precious metals allocation, diversification across forms, vehicles, and timeframes reduces risk without proportionally reducing expected returns. A mediocre investment with appropriate position sizing will do less damage than a brilliant investment with inappropriate position sizing. Most investors obsess over what to buy while neglecting how much to buy. Reverse this priority. An asset you cannot sell when needed is worth less than its quoted price. Ensure your precious metals holdings include sufficient liquidity for foreseeable needs. This may mean accepting lower returns on liquid positions to ensure accessibility. Before establishing any position, ask what would happen if prices declined 50% from here. Would I be forced to sell at the worst time? Would my financial situation become precarious? Would my conviction in the thesis survive such adversity? If the answers reveal vulnerability, adjust position size until the answers become comfortable. Good decisions sometimes produce bad outcomes. Bad decisions sometimes produce good outcomes. Judge yourself on the quality of your decision-making process, not solely on results over any particular period. A sound process applied consistently will produce good results over time. An unsound process that happens to work once will eventually produce disaster. Throughout this discussion, I've emphasized understanding over prediction. This reflects a core belief. Educated investors make better decisions than those relying on tips, hunches, or authorities. Take ownership of your financial education. Understand the assets you hold. Understand the markets in which they trade. Understand the forces that drive their prices. This does not require becoming an expert in precious metals, metallurgy, or commodities trading. It requires building sufficient knowledge to make independent judgments and avoid obvious mistakes. Read broadly. Consume perspectives that challenge your assumptions, not just those that confirm them. The best investors are perpetually curious and perpetually humble about what they might be missing. Develop mental models for how markets function. Supply and demand dynamics, cycle patterns, sentiment indicators, institutional behavior. These frameworks provide structure for processing new information as it emerges. Understand your own psychology. Know your emotional vulnerabilities. Know your tendencies toward fear and greed. Know what conditions trigger impulsive behavior. Self-knowledge is as important as market knowledge. Build a network of thoughtful peers. Isolated decision-making is vulnerable to blind spots and motivated reasoning. Discussing ideas with others who think critically and independently improves decision quality. Education is not a one-time event. It is an ongoing process that continues throughout your investing career. The markets evolve, new information emerges, and your understanding should deepen correspondingly. We've covered substantial ground today. Let me bring the key themes together in closing. Silver is experiencing a convergence of factors that merit serious attention. Industrial demand is structurally increasing. Court developments are shifting market dynamics. Monetary conditions support precious metals generally, and the asset remains underowned relative to historical norms. This is not a guarantee of price appreciation. No such guarantees exist in financial markets. But it is a setup that thoughtful investors should evaluate carefully against their own circumstances and objectives. For existing holders, the appropriate response is disciplined holding with predetermined rules for both corrections and profit-taking. Emotional reactions to volatility are your primary enemy. For potential investors, the appropriate response is thorough evaluation of whether silver fits your overall financial plan, followed by systematic position building, if the answer is affirmative. Rushing into concentrated positions based on fear of missing out is not a strategy. For everyone, the appropriate response is continued education and emotional preparation. The coming months and years will likely feature substantial volatility. Those who are prepared will treat volatility as opportunity. Those who are unprepared will treat it as torture. The financial world contains no certainties. Every decision involves trade-offs and probabilities rather than guaranteed outcomes. Accept this reality and work within it rather than pretending it away. Your goal is not to achieve perfect results. Your goal is to make sound decisions consistently over time. The compounding of sound decisions, even imperfect ones, produces wealth over years and decades. Silver may be part of that journey for you, or it may not. That depends on factors unique to your situation that I cannot know. What I can offer is a framework for thinking clearly about the opportunity, a framework that values discipline over excitement, education over prediction, and long-term wealth building over short-term speculation. The storm in the title is not something to fear. It is something to prepare for and potentially to benefit from. Storms redistribute assets, from the undisciplined to the disciplined, from the emotional to the analytical, from the unprepared to the prepared. Choose which side of that redistribution you will be on. Thank you for your attention through this discussion. I hope it has provided value for your thinking, regardless of what decisions you ultimately make. Stay disciplined, stay educated, and stay focused on what matters. If you found this analysis valuable, consider subscribing to join a community committed to thoughtful, disciplined financial thinking. Subscribe. We'll continue bringing you measured perspectives on the developments that matter for your financial future. Until next time.